So I acquired a skilled nursing facility at what was inarguably the height of the market in kind of late 2021. Maybe I closed early 2022, and I certainly paid a premium for it, like many other SNF buyers at the time. And I financed the deal with a 90% loan to value loan from a debt fund. However, in the years since, I've had bad staff turnover. My Medicaid rates have not risen enough to cover my staffing and other costs. And I've resorted to using some agency labor. So at the moment, I'm currently operating just below break even, but my loan is coming due in 6 months. So Nick, I'll throw this one just at first to you. As a borrower, should I refinance or should I just sell at this point?
Yeah. I think first I would say a little prayer as well. This is a tough situation to be in,
Maybe a
and
slap on the hand for waiting until 6 months out from when my debt is maturing too.
right. Uh, yeah, no, this is indicative of a lot of borrowers, even on the seniors housing side, unfortunately. I think, gosh, this is one where if you do get an extension, you're likely going to be pressed with a remargining of the account. The banks are likely going to be pushing you to resize this to whatever LTV they're comfortable with, but bringing in equity and deleveraging to hit that point. More than likely, a loan like this is going to be on the lender's watch list, and likely it's in some type of technical default from a covenant perspective. So, there's a lot of conversations that this, that you as the borrower are having with the bank. Um, to me, looking at this, it one of the things that I think of is, well, what's your liquidity position? Right? Because to keep this asset, you're probably going to have to reinvest in this, put more equity into it to deleverage it in the short term in order to keep, in order to maintain ownership of it. Um, on the flip side, with maybe a 10% reduction in value, you might be able to sell this asset and still get out, not like lose your equity, but get out with the bank being repaid. So I think you're in this dynamic where if you have strong conviction around the medium term, let's say the next 3 to 5 years for this specific asset, and you have the capital to fund a deleveraging, I would try and work with your existing lender, or possibly shop this out to other bridge lenders, banks, to see the best deal requiring the least amount of equity in order to put a new financing in place and extend that time frame. If you don't have that conviction, if you're not convinced that this is an asset you want to, double down on, then I'd be looking more towards a sale. You're going to realize a loss in that case. I think it's highly unlikely you're not going to realize a loss, and hopefully it's no more than the equity you've already put in. But I think that's the kind of take your lumps and move on to live another day is a little bit of that strategy. So that would be my kind of advice to you as you're thinking about it, and be looking at your capital position, looking at your conviction over the asset, and that gut check, I think, really kind of tells you whether you take your loss, move on, or you double down and live to try and recoup it in another day.
Actually, so I'm actually surprised by Nick's answer. I had thought, reading the stock pattern, just seeing kind of the way in which like I said, the banks have sort of come back into the skilled market in a pretty meaningful way. I feel I had thought that a refinancing could actually be effectuated here, and that they might actually get some financing bids. And I can just think of a different fact pattern, or to sort of build it out a little bit more. Like, if you're Ben, to use you as a sponsor, where purchase this asset at the height of the market, maybe you bought it from a hospital, maybe the sort of right sizing the agency staffing was sort of your business plan. You misjudged the labor market, you had a hard time recruiting full-time employees. I think even in that case, even you can sort of tell a story, and maybe the story is that the agency costs have come in, you're sort of on a path to profitability, ADC has gone up, and maybe the quality mix has gone up. I don't know. I mean, I could very well be wrong, and maybe this isn't the market today, but it does feel like maybe you get some bids, and maybe there's a market for it. But again, I think it's a sort of that is a reflection of kind of the recent sort of re-entry of banks into the skilled market, and it happened sort of almost like a light switch. So, but
So it's funny, guys. I agree with you both, and I know that this is partially just the way Stephen Rowe probably wrote this. But the two things that I would lead with in any scenario, even remotely similar to this, is 6 months is not enough time. Everybody should be looking at every asset that they own or control within their portfolio with a super long runway. I mean, a deal that's not cash flow positive, with a deal that's maturing and agency costs, Medicaids, and all of those things, trying to decide what to do with 6 months left is the equivalent of trying to take a B-52 and launch it off an aircraft carrier. You need more runway. And again, part of it is just the way this is worded. But what I would tell any partner of mine or any contemporary of mine in this space, as well as the seniors housing space, is you've got to be looking far enough ahead that you can weigh all the potential options. Zach, to your point, I think that the banks have increased their appetite for putting more bank debt out there, more so than they were 6 months ago. But I look at this situation and a number of questions immediately come to mind. Number one, is the asset a core holding of mine as it relates to a portfolio that I may own, or what my primary occupation is? Because that's going to drive my willingness or interest in a potential sale. Number two, things like Medicaid rate, other costs, agency labor. What is the pattern here? Are costs increasing? Are they mitigated because the labor market has begun leveling off, or are they increasing? Those are meaningful things that one needs to answer about the operational profile of their individual property. Success sells. If you were to bring a property to market where you're showing an increase in agency labor rather than a period over period decrease in agency labor, you're going to make your asset less attractive in the transactional marketplace, because people will factor that pattern into the future valuation of the asset. So a lot of words. You need runway. You need to engage with your existing lender, and you need to engage in the lending community to find out what their appetite is for potential refinance. Nick, to your point, if this is a core asset, if it's a relevant asset, if it's something that you want to hold on to, you need to evaluate your cash position, your equity position, and whether there's a way to sort of double down on your investments in this asset and hope for better weather. But to not give yourself enough runway, to not engage with the lending marketplace, and to not have a complete understanding of your operational profile will put you at risk for not maximizing value, either on a refinance or on a sale.
So how much runway from the borrower's perspective and from the lender's perspective do you need for an asset that's currently struggling?
To me, we look at all of our holdings on a monthly basis. That doesn't mean we're actively engaged in a refinance, but having a full understanding, specifically, Ben, as it relates to operational performance, we look on a month-over-month basis. What's going on with agency labor? Has it increased? Has it decreased? What's the prospect for a decrease in labor? What are our open positions, right? Specifically, executive director, director of sales, director of food service, director of maintenance, and director of care. Do we have open positions there? What's the impact on occupancy and operational performance with those open positions, right? So we're looking at those there's no timeline on this. We look at those every single month. As it relates to pending maturity, I think a year out is absolutely essential. Now, whether it's 12 months or 9 months or whatever, 6 months doesn't give you enough time. Nick and Zach, I defer to you guys because of skilled nursing, but in 6 months, are you going to be able to transfer a certificate of need to the buyer. I mean, I don't even know whether 6 months is enough time in today's environment to conclude a transaction. But I would say a year is a good runway.
Yeah, I think that's right. I mean, I think nine months, would be, should be a comfortable. A year is a very, doable. But you're absolutely right, Matthew, with the chow process. I mean, there's the whole marketing process, there's the negotiation process, and then there's the chow and closing process. I think that brings up another kind of side point here. And again, the timeline to think about financing, whether that's with a current lender or with a different lender, is one that requires a lot of time. I think on the skilled side, if this is maybe more of a non-core, like Matthew kind of bucketed it, then maybe looking at a third-party operator and looking at providing someone a lease to purchase option could be an attractive stair-step way out of an asset like this. Again, if it's a non-core, maybe there's an operator. Again, I think Matt, you ask great questions, right? Where does this fit within your overall portfolio? I mean, if you have density in this market, then you should have the operational prowess in order to be able to fix this and work it out. If this is a single asset in a market where you don't have density, then maybe leaning into an operator that does have density in that market that can bring that, where you could negotiate a lease purchase, could be a great arrangement. That may help with the financing if that's a known operator. So there may be some kind of split the baby, scenarios here between a hold and sell by bringing another operator in. That may defray some of your costs, right? If they're going to take on the working capital of that lease. So that'd be another scenario I think would be worth entertaining in the mix of assessing whether this is kind of a core, non-core asset.
Yeah, Nick, I think you touched on something which I didn't, so I'm going to give you kudos for that. I think one of the things that all borrowers and sponsors need to think about is creativity, right? So down the middle of the fairway, I own this. I'm going to get 65 to 70% LTV. I'll get a waiver for this. I'll get a waiver for that. Those days have been dramatically altered, and people need to think in terms of outside the box. So you raise a really good scenario, Nick. Like, if there's somebody in this marketplace with better density and better operating performance, frankly, is there some sort of partnership or future transaction? That's creativity, right? That's talking to your competitor, right? But it may translate into the ultimate return to you as an investor, right? And so I would not rule out creative thinking, in addition to the time that we mentioned earlier.
Yeah, it's interesting. And Nick, you mentioned, like a lease, executing a lease with a separate operator, but I think there's an intermediary step, which we've seen, which is just a third-party consultant advisor stepping in and, sort of helping with right-sizing the operations, maybe with an eye towards, eventually purchasing it. And I think that can be also sort of an interesting, scenario.
And one more thing I would tell you as a debt fund lender, we like it when our sponsors are acting in the best interests of the asset. We like when they come to us and tell us they've got a problem and here's how they're going to fix it. So again, engaging your existing lender is paramount to a successful outcome. That, a lender who is told with 6 months left that, they're not going to be able to pay you back is going to be a very different animal to pet than when you have a conversation with a lender saying, I've got a year to go. We got some issues. Here's what we're thinking about doing. We invite your comments. We're hiring, Zach, to your point, we're hiring a third-party consultant. We're gonna get down to brass tacks. We're gonna tell you what's going on, but we're treating this as an above-board dialogue with you, so you know exactly where we're at. I think it's really important in today's lending environment that there's transparency.
Well, then if the lender just put down the latest issue of the Senior Care Investor and saw that prices for skilled nursing facilities, even for ones that are not so stabilized, are still decently high in this market. And so from the lender's perspective, with that in their mind, do you just take the keys and go out into the M&A market or offer an extension? What do you do there?
Lenders don't want keys, Ben. Regardless of market value, lenders don't want keys. The costs associated with foreclosure, the intricacies of license transfer, the associated liability of providing care to the senior as a holder of the deed are all things that would like to be avoided by lenders, regardless of market value. I think market value is important, and Lord knows everybody reads the Senior Care Investor. Anybody does. But lenders don't want keys. I don't think that is a strategic option for a lender.
I agree. I do think that it may, absent that open communication that Matthew mentioned, which I would second and third, the lender may develop their own feeling that a sale is the only way to get out in 6 months. And so if they feel like that's actionable, maybe they've gone and got a broker opinion of value that says, hey, we can get out, right? This thing can trade at 92 cents on, from its purchase. They're probably going to take a harder stance in enforcing either a major paydown or a sale in that maturity. And so I think that's going to influence the behavior that they may take, or the posturing that they may take, and how quickly they want this thing off their book. But I agree wholeheartedly with Matthew. No one wants to take the keys unless you're a loan-to-own lender, which I don't think this is representative of.
And the other thing I'd say is, I think, Matt, Nick, Ben, I'd love to get your take on it, but it feels as though the sort of loan sales market, as it relates to sort of stressed or distressed assets, really hasn't sort of materialized the way that people had thought. And a lot of these assets, are sort of remaining on the balance sheets of either banks or, in sort of with debt funds, in banks in particular, they get a modest pay down. Maybe there's some modifications. It feels like they're kind of willing to keep the asset on their books. I mean, I'd love to, Matt, I don't know if you've looked at some note sales, or Nick, you've facilitated them, or
We've certainly looked at the more than our fair share of them, and again, just stepping back, Berkshire, since COVID outburst, we've kind of prided ourselves as looking for ways to provide capital to the hole in the capital stack, wherever that is. And for a long time, the previous 12 to 18 months, we thought that hole in the capital stack was the difference between market value and maximum leverage that could be obtained given the current value of the property and what the debt balance was for a maturing loan. And so conceptually, we thought that hole in the capital stack could be filled with an exotic, whether that exotic is mezzanine debt, pref, any number of those things, an A and a B piece, a B piece portion of existing loans. So we looked at a number of different ways to do that. What our experience generally suggested to us is that most banks did not want to take a discount on the face value of their property in order to get out of the asset based solely on maturity default. So we, as an industry, have been talking about this wall of debt maturities for the last year, and it's going to go forward. I think the latest number that Senior Care Investors suggested was somewhere around 18 billion in the next 12 to 18 months of maturing debt. At Berkshire, we looked at that as a tremendous opportunity to provide capital to relevant properties with good operations, blah, 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 that couldn't meet the obligations of the maturing debt. But what we found, and Nick, I'd be interested in your comment here, but what we've found is, by and large, we could not arrive at an agreeable discount to the face value of the loan where we could come in and provide that whole, the capital for the whole.
Yeah, I mean, I think looking at the market, I would say that we've been surprised at how much. I mean, extend and pretend or survive till 25, right? It's sort of been the mantra now for a year. And I think that there's a few factors, Matthew, what you said, which is banks are just really reticent to take. They may have already taken a write down, unrealized on their books, right? Yes. So they've already washed through at least one financial cycle, some amount of loss reserve for this book. I think they're very hesitant to realize that loss or write down further At the same time, I think a lot of the owners of these properties feel like they don't want to accept a compromised value, and that if interest rates just come back, if a liquidity just comes back, if cap rates just tighten up a little bit, we're going to see the ability to exit these at break even to a slight gain.
Right. The hang
And
on
I think
to.
that's led those owners to say, I'll continue to feed sort of the negative cost of higher interest rates to a point because I can still see that as good money after good.
Yeah.
And I think time will tell whether that's good money after good or good money after bad, depending on what happens with interest rates. But I
Yes.
think it's that combination of bank posturing
Yeah.
and operators willing to continue to write capital call checks for the foreseeable future. And I think hopefully we see rates decline and we can work our way out this with a recapitalization of that 18 billion. But that's sort of the crystal ball that we're all really interested in looking at.
Yeah, and I'd layer one more thing on, and I know, Ben, we got to move along here. We're going to run out of time. But the other thing is when you think about a third party providing capital to the hole in the capital stack, if you're thinking about a B piece to an A-B structure for an existing loan, or you're thinking about, take a $10 million loan and the bank will, you think maximum leverage is 7.5 million, then you've got a $2.5 million hole. And that can come in the form of mezz debt, pref equity, B piece, all of which command higher pricing because the relative risk of that B piece is much higher because you're second in the lien formation in terms of being able to get at the actual equity. So it's going to command higher pricing, and sponsors will look at the overall cost of keeping the 10 million alive with a maturity default, but paying the same spread versus putting the loan back in compliance and actually paying more for the capital for the existing balance. They choose not to choose option 2.
Yeah, and I know that we've worked with sponsors that we like and respect who have just to sort of set the sort of like put out a fact pattern. They've developed an asset, the loan is matured, and maybe it's a construction loan that they thought they were going to refinance and there's no permanent option. But there's maybe a syndicate of banks and one of the banks wants to stay in. We've explored options where maybe we can slot ourselves in as the preferred piece, pay off the bank that maybe is exiting the space, doesn't want to be there anymore. But even those conversations have just been difficult, in part, Matt, to your point, the banks don't want any sort of discount. They don't want to realize that loss, even if they've written it down. It's in sort of a criticized asset group. And then also it's just I think not sort of of the mindset today. I think maybe it's a little bit of things are going to improve, rates are going to go down, maybe we can get some additional capital from the sponsor who's going to sort of continue to feed this because the value may be there in the future. So all that being said, it's interesting. It's definitely an interesting time.
Yeah. No, I appreciate the longer discussion on this too, because I think this is generally a situation that a lot of people have found themselves in and or currently find themselves in. So I think it's certainly worth the discussion. But let's move on. I think also the number one takeaway from the previous slide was you need more than 6 months runway. And one of our audience members agrees it's 9 to 12 months, if not longer, perhaps. So thank you all. Move on to this one. I'm a smaller mom and pop owner operator, and I want to acquire a newly built but not stabilized seniors housing community in my secondary market, but I cannot pay all cash. But I hear there's a lot of deals like that out there, and those are the deals that I think I can get at a discount and make a killing off of, I've heard. So what's my best financing option? And can I have some CapEx funds too? Or should I even consider this if I'm not able to support 1 or 2 years of losses before stabilization?
Yeah, I mean, candidly, I think at Logan's point, we really like these deals. I think that we see it as a really attractive time for, particularly, regional focused operators and owner operators that are looking to either expand or, purchase their first asset. And, there's 2 things that are going on. One, at least as we see it, the fundraising environment has been really difficult for a lot of, equity funds. And so, as it relates to that, some of the LP capital that was there several years ago is just harder to come by, and maybe there was a sort of programmatic JV that an operator had, and that capital just isn't particularly active today, and so they're sort of looking, they pick their heads up and they're sort of looking out as to, what they want to do. And the other piece of that is, we do see some inefficiencies in the market, particularly in the, sort of, smaller, MSAs, smaller markets, and the sales in those markets are, attractive to, these owner operators. They can pick up assets that are, below replacement cost. Like I said, I think earlier, some of these are lender led deals. You can get it just about the cost of the debt. And there, if all those things are true, I think for us, we like to back those people. So we come in and we provide, and oftentimes a majority of the capital, and we will structure it as a preferred, as a whole loan. From our perspective, it can be cut in a variety of different ways, but from the owner operator's perspective, there's sort of the ability to pick up an asset, to own the real estate, to sort of execute on a business plan, and sort of do what they're very good at, but also from their perspective, take that upside to themselves. So I think for us, these are attractive opportunities, and today there's inefficiencies in the market, and these opportunities exist, and while they exist, we're chasing them, but I don't know how long that'll be. So
yeah, so Matthew, that deal from Locust Point sounds pretty good. Should I go with it?
So I was just going to comment that Zach and his company have been really one of the foremost players in providing these kind of solutions, and so I tip my hat to Locust Point, perhaps. Right. So let me back up a little bit, Ben, and to say, look, if there is a community that you're interested in, right, and this goes back to the previous scenario, engage and be creative, right? So what's the best financing option, and can you find CapEx funds too? I can tell you the answer is no if you don't ask anybody, right? And so there are a lot of things going on. This is a extremely interesting and extremely complex transactional marketplace. You may talk to some of the public REITs and say, man, it's not that complex. If we want it, we can buy it. That's not true of every single asset out there. There are, people's shopping lists, the folks who have equity to deploy, whether it's private equity, individuals, or REITs, they've got pretty narrow shopping lists, right? So the asset described in this scenario may not even be attractive to some of those larger equity sources. So this is the entrepreneurial spirit at work. Go after this thing and figure out what the best scenario it is. So Zach and his team have provided some really imaginative and very good solutions to situations just like this. There very well could be private equity funds who have money to deploy that haven't found this asset, that are looking to establish a new relationship with a mom and pop type of operator, and they may be willing to structure a joint venture, which not only allows you to transact on this particular property, but may give you some gunpowder to buy the next one. So these are just the type of situations that I would say that this environment is going to produce, and you should pursue them if it's part of your business plan to grow and acquire.
Yeah, I think it's a great line of creative thinking. A lot of times these situations are created by an owner and or a lender, right, that's unwilling or unable to continue to support this project. So they've kind of thrown up their hands, the seller, and said, hey, I have to sell this because I've lost my basis, or the lender's forcing me out. So I think that these tend to be opportunistic in nature. One other sort of creative component I would think of is whether there isn't a seller financing option in this case. Maybe there's the opportunity to almost partner with the seller and say, I'll come in with some fresh equity, give you the ability to maintain some upside in this, either through a debt vehicle or retaining some equity. And use that as a way to recap and give this some more runway. Coming in, the mom pop operator, rebases or gets in at their attractive basis. And so that could be another way where you kind of think about a lower cash in method of financing. If like a Locust Point, higher leverage acquisition vehicles not available, or just doesn't work, and you're forced with an existing, lower leverage lender. So I think that's another piece that I would add to the sort of pile of creative thoughts there.
Yeah, and just along that, Nick, just to bring up what you had mentioned in terms of the SNF owner operator in the example before, maybe there's a lease option purchase for that SNF operator to get right-sized. Shoes on the other foot here. Maybe there's an opportunity to come in and be creative. To your point, bring a cash infusion in exchange for a future purchase option. So you arrive at current purchase price, you provide the equity that is needed to get the thing turned around, and you have a fixed purchase price in the future where you can realize the advantage of acquiring in this current marketplace.
Yeah. I think one other thing I'd say, and Zach, this is I'll kind of tee this up because I think this is for you to answer, but having a rock solid game plan, if you are this mom and pop owner operator, around what you're going to do with these assets is key to any lender. All three of us are going to want to understand your story. How well are you operating the assets that you have? What improvements have you put in place? How have you weathered COVID? How have you weathered inflation? How have you weathered staffing challenges? What will you bring to this asset that you're looking to acquire that will help it to be, cash flow positive and accretive in the future? And so, this is really where the story of your business, the vision, the historical success, the future focus is, and your financial wherewithal, right? What's your credit? What's your capital? Are going to be key to getting anyone, whether it's a manage buyout, lease buy, or a high leverage financing. Any lender or partner is going to want to see that vision, buy into that vision, and feel like they're making a bet that's worth making.
Yeah, I completely agree, Nick. I think you said that really well, and I think for our perspective, a lot of times when we're backing these owner operators, particularly on their first purchase or as a sort of an add-on or expansion, it's groups that we like to do business with. It's groups that we trust. It's groups that we can look back and sort of see either the value creation or kind of their ability to sort of stand behind assets. And I think that being able to tell that story and sort of describe the value creation and how you operate is incredibly important. So yeah, that's well said.